Welcome back, my friends. The news today is that W.P. Carey is divesting its office properties and decreasing shareholder dividends. It's time to sell the stock and put your money to work elsewhere. And, of course, the long-growing dividend is getting cut. W.P. Carey is just the latest of the big real estate investment trusts to fall victim to the weakening commercial real estate market. W.P. Carey shares fell 8% after plans to exit office market and cut the dividend were announced. What does it mean for real estate investment trusts? What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And, before we continue, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty. Nurses, and that includes all grades of nurses. Lawyers, regardless of area of legal focus. Teachers and professors, from kindergarten through graduate school. As well as any kind of job that requires a government license or certification. And ProWorld.net also includes short-term gig-type jobs as well. So, be sure to check out ProWorldNet.com if you are looking for a job or an employee. Shares of W.P. Carey fell after the real estate investment trust laid out its plans to exit the office building market and said it would likely cut its dividend. Shares fell 8% to $58.81 in afternoon trading. So far this year, the stock is down about 25%. The company said Thursday it plans to sell some of its office buildings over the next few months and spin the rest off into a separate, publicly traded REIT. W.P. Carey would likely cut its dividend as a result, Chief Financial Officer Tony Sanzoni told analysts on a conference call. Once the deals are done, about 60% of W.P. Carey's portfolio would be tied to industrial real estate and warehouses, Chief Executive Jason Fox said. The REIT, he said, has been gradually exiting the office market for years, even before the pandemic dealt the sector a blow. W.P. Carey is a real estate investment trust, which owns and leases high-quality mission-critical commercial properties. The company was founded in 1973 and has been increasing its dividend every year since it went public in 1998. This is a very impressive feat, which puts WPC in the prestigious category of the so-called dividend aristocrats, companies, which have been steadily raising their payouts for at least 25 years. Unfortunately, it looks like W.P. Carey will not be able to make it 26 in a row. The COVID-19 pandemic and the work-from-home shift it caused decimated the office subsector of the real estate market. Nobody wants to pay the rent for an office building that stays empty. The problem is that WPC has some of those. So, last week, the company announced that it was going to spin off its office real estate portfolio into a separate public entity. That's the good news. The bad news, which sent the stock nosediving, was the 10%-15% dividend cut, which is likely going to follow. REITs primarily attract dividend investors, who are especially unforgiving when it comes to a decrease in their payouts. On the other hand, W.P. Carey is still a very high-quality company and the planned spin-off would only make it better by de-risking its business. Does this mean that the current sell-off is a buying opportunity? At first glance, it definitely appears so, given WPC's rather low P/FFO multiple. However, real estate valuations tend to drop in recessions and there's a good chance we're still headed for one. The commercial real estate industry is facing an unprecedented era of uncertainty. One of the primary concerns is the influence of inflation and interest rates. The pandemic has brought about lower occupancy rates and changes in where people work and how they shop, leading to falling office and retail property valuations. Despite these challenges, the commercial real estate market has not gone bust yet. According to a report by JLL, asking rents for office properties rose nationally by 0.3% between the final months of 2022 and the first quarter of this year. Banks continue to support commercial properties, with loans for commercial real estate at an all-time high of $2.9 trillion as of May 2023. However, there are warning signals in the U.S. commercial office markets. Property investment has plummeted, leasing activity has dropped, delinquencies have surged, and maturing mortgage loans face starkly higher refinancing rates. Large global firms plan to reduce office space as the trend toward remote work that accelerated during the pandemic persists. Investors are concerned about a potential crash in the commercial real estate market. According to Bloomberg's latest Markets Live Pulse survey, office prices in the US are due for a crash, and the commercial real estate market faces at least another 9 months of declines. According to a report by Investopedia, the market for office property has tanked, and office-based real estate investment trusts, REITs, measured by the FTSE Nareit Equity REIT Index dropped 37.6% in 2022 and another 18.1% in the first 4 months of this year. Nationwide, the commercial office market suffered $506 billion in losses in the 3-year period ended December 2022-1. The decline in the commercial real estate market has led to a significant drop in the value of office-based REITs. The report by Investopedia states that the market's woes have an array of implications for tenants, lenders, investors, property owners, and municipalities. 1. The report also highlights that banks and financial institutions are at risk due to the decline in office property values. Office assets are often financed with debt that resides on banks' balance sheets and in commercial mortgage-backed security, CMBS, portfolios. Large declines in value would have consequences for institutional investors and for financial stability. Overall, it seems that office-based REITs are facing significant challenges due to the decline in commercial real estate values. Northwest Healthcare Properties Real Estate Investment Trust, a healthcare REIT operating in multiple countries, unveiled a series of initiatives aimed at boosting its financial position. Key moves include extending its credit facility's maturity date, the sale of assets, and a large 55% dividend cut. Medical Properties Trust has announced the adoption of an updated capital allocation strategy, with the aim of bolstering its balance sheet, reducing its cost of capital, and positioning the company for long-term value creation for its shareholders. The revised strategy places a priority on expediting debt reduction while also maintaining a focus on returning significant cash to shareholders. With this refreshed capital allocation framework, we believe MPT will be even better positioned to deliver long-term value through our profitable investments in hospital real estate, said Edward K. Aldog Jr., Chairman, President, and CEO. As we made clear during our recent quarterly earnings update, our focus is squarely on reducing leverage and improving our long-term cost of debt and equity capital. Our board is confident these decisive steps will facilitate achievement of our target leverage ratios and create significant strategic and financial flexibility. Over the past 18 months, MPT has undertaken a series of transactions that have impacted adjusted funds from operations, AFFO, including some pretty bold moves. Partnering with Macquarie Asset Management for 8 Massachusetts hospitals. Repurchasing 14 facilities from Prime Healthcare. And selling 7 Australian hospitals. The company has also announced additional transactions slated to close in the latter half of 2023. These transactions include another couple of bold moves. The sale of its Connecticut hospitals to Yale New Haven Health for approximately $355 million. And the remaining Australian portfolio for about $300 million. While these transactions have been profitable, they have led to a reduction in MPT's leased assets by approximately $2.5 billion. Moreover, MPT has announced today it will declare a quarterly cash dividend of 15 cents per diluted share. This dividend will be paid on October 12 to shareholders of record as of September 14. The initial payout aims to be less than 60% of the projected near-term OFO. The company will also pursue carefully chosen additional transactions that strengthen underwritten asset values. This includes exploring refinancing, sales, and joint venture opportunities that facilitate debt repayment. Finally, the company said it plans to scale back discretionary operating expenses and other costs to align more closely with the reduction of its asset base and near-term acquisition activities. CEO Edward Aldog outlined ambitions to trim down debts and better position the company financially. This significant dividend cut, dropping to 15 cents from a previous 29 cents, aligns with their current strategic adjustments and financial targets, including plans for future investments and a closer look at operational costs. Northwest Healthcare Properties Real Estate Investment Trust, NWHP REIT, is a Canadian real estate investment trust, REIT, that specializes in owning, managing, and developing a portfolio of healthcare-related properties. It is focused on healthcare real estate assets, including medical office buildings, clinics, and hospitals. NWHP REIT's primary goal is to generate stable and growing income for its investors by owning and leasing healthcare properties to healthcare providers and organizations. And this is not the first high-profile medical properties trust to cut its dividend. Medical Properties Trust did the exact same thing 2 weeks ago. Medical Properties Trust is a Birmingham, Alabama-based company that focuses on acquiring and leasing healthcare-related properties, particularly acute care hospitals. The company was founded in 2003 by Edward K. Uldog Jr., a seasoned real estate executive. MPT was created with the intention of capitalizing on the growing demand for medical facilities and healthcare services due to an aging population and advancements in medical technology. The company's business model involves acquiring properties and then leasing them back to healthcare operators under long-term agreements, generating a stable income stream. By this point, MPT's portfolio includes a diverse range of healthcare properties, such as acute care hospitals, rehabilitation hospitals, and outpatient facilities. The company benefits from the essential nature of healthcare services, which tend to be resilient even in times of economic uncertainty. Throughout its history, MPT's business model has been to acquire healthcare properties and enter into long-term triple net lease agreements with established healthcare operators. These agreements typically require the lessees to cover property-related expenses such as maintenance, insurance, and property taxes, which provides MPT with a predictable and stable income stream. It's important to note that the healthcare industry and real estate market are subject to various changes and challenges over time, which can impact the performance and growth of companies like Medical Properties Trust. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.